Hi everyone, Rosie here. So I've worked with IFRS in practice for many years now, and I've also marked professional accounting exams. So on this channel, what I do is break down complex accounting standards and explain the real logic behind them so they actually make sense for you in your SBR exam. So let's go. Hello, welcome back to SBR Technical Deep Dives. So I'm Rosie, fellow of FCCA and head of technical accounting and all things IFRS. And today on this episode, we're going to talk about fair value hedges. Now, hedging is one of those topics that sounds more complicated than it actually is. So what I'm going to do is break down exactly what a fair value hedge is, why the accounting works the way it does, and what you actually need to understand to handle it in an exam question if it comes up. So let's get into it. So first, let's think about what we're actually hedging. So a fair value hedge is used when a business has an asset or a liability whose fair value could change. Yeah, and that change would hit the P&L. So the business wants to protect itself against that movement. Okay, so what it does is takes out a hedging instrument, and that's usually a derivative like an interest rate swap or a forward contract or something like that, and that offsets that hit in the P&L. Now, a classic example is a fixed rate borrowing. Okay, if you've borrowed money at a fixed rate, the fair value of that debt on your balance sheet moves with the interest rate. So if the rate goes up, then the fair value of your fixed rate debt goes down, and vice versa. Okay, and that's risk to the business. Okay, and a fair value hedge manages that risk. So in a fair value hedge, you've two things. You've got the hedged item, that's the asset or the liability that you're wanting to protect, and you've got the hedging instrument, and that is the derivative you've taken out to offset that risk. Okay, so simple so far. We've got these two things, but let's think about where it gets a little bit more interesting. So normally under IFRS 9, if you have a derivative, it sits on your balance sheet at the fair value, and any movement goes straight to profit and loss. Okay, fine. And normally a fixed rate borrowing would sit at amortized cost on your balance sheet and doesn't get remeasured at all. So without the hedge accounting, you've got a mismatch. Your derivative is moving through the P&L every period, but your borrowing isn't moving at all. And what that does is it creates artificial volatility in your P&L, big gains or losses on that derivative with nothing offsetting them from the hedged item. So what hedge accounting does is it fixes that mismatch. It says, if you're using this derivative specifically to hedge this borrowing, we'll adjust the accounting to reflect that. We'll remeasure both of them so the movements offset each other. And that is the core logic of a fair value hedge. You remeasure that hedged item for changes in the hedge risk, and in our example, the change in fair value of the borrowing due to the interest rate movements, and you take that change to the P&L. The derivative's already going to profit and loss at the fair value. So if the hedge is effective, the two movements cancel out, okay? And that P&L is protected. And that's it. That's really the whole idea. So let's make it a bit more concrete and think about the journal entries, because I think that this is where students sometimes get a little bit lost, find it a little bit challenging. What's the debits and the credits? So let's say you've got fixed rate borrowing, okay? That's your hedged item. And you've taken out an interest rate swap to hedge it. That's your hedging instrument. So at each reporting date, the hedging instrument, the swap, is remeasured to fair value. If it's an asset, the debit is on the derivative asset and the credit goes to P&L. If it's a liability, opposite, debit to P&L, credit the derivative liability. That is just normal IFRS 9. There's nothing special about that. That instrument is under IFRS 9 on its own. Now let's think about the hedged item, the borrowing. That is adjusted for the change in the fair value that's attributable to that hedged risk. So if the interest rates have moved and the fair value of the borrowing has changed, you adjust the carrying amount of that borrowing to take the opposite side to the P&L. So if the hedge is perfectly effective, the gain on one exactly offsets the loss on the other. So that net P&L impact is zero. And that is the whole point. Okay. Now, in reality, in the real world, hedges are really perfectly effective. Okay. So you will get a little bit of ineffectiveness in the P&L, but the same principle holds. You're offsetting the majority of that risk. Now, hedge accounting isn't automatic. You can't just decide I'm going to apply it retrospectively when it suits. IFRS 9 is very, very specific, and it requires 3 things to be in place before you can use hedge accounting. First thing, there's got to be a formal designation and documentation of that hedging relationship at the start, at the inception. Who's hedging what, with what instrument, and for what risk. It needs to be written down at the start. That's the first thing. The second thing is that the hedge must meet the hedge effectiveness requirements. So the hedging instrument and the hedged item must be economically related. So movements should offset each other, and the effect of credit risk shouldn't dominate ultimately. And the third thing is that the hedge ratio must be the same as the ratio that the business actually uses for risk management purposes. So in the SBR exam, the documentation point is the one that is most commonly tested. So if the question or the scenario tells you that no documentation exists, hedge accounting can't be applied. Okay, full stop. The derivative still goes fair value through P&L. You just can't offset it against the hedged item. Okay, that is one clear point, and it comes up often in this area. So one thing that's worth being clear on, because it does catch people out, is that fair value hedges are different to cash flow hedges. So in a fair value hedge, both movements go to profit and loss and offset each other there. In a cash flow hedge, the effective portion of the hedging instruments goes to OCI, not profit or loss. It sits in a hedging reserve until that hedge transaction actually impacts the P&L and we reclassify it. It's a different risk and it's different accounting. Okay, fair value hedge, you are protecting against the change in fair value. Cash flow hedge, you're protecting against variability in future cash flows. Okay, we are going to cover that in a later episode in terms of the cash flow hedging, but just a distinct point that you need to remember. So let's wrap it all up and pull it together. A fair value hedge protects against changes in the fair value of an asset or liability on the company balance sheet. The accounting remeasures both the hedged item and the hedging instrument through profit or loss, so the movements offset each other. You need formal documentation at inception for hedge accounting to apply. And the key distinction from a cash flow hedge is that the fair value hedge, everything goes through P&L and nothing sits in OCI. So that's fair value hedges, clean, logical, hopefully. And once you understand why the accounting works the way it does, it stops feeling so complicated. All right. So I'll be back in the next episode with another deep dive where we're going to cover those cash flow hedges. All right. I will see you soon.